Hello everyone, a warm welcome to everyone on our channel Ground Reality by Address Advisors. It has been some time, when we did the last podcast, there was some gap, of course, there are a lot of things happening on ground. We were also doing a lot of transactions. Good action was happening in Bangalore. Touchwood this year is really good. Almost half year is gone. And I must say, it's much, much better than what we anticipated or expected. It's doing very good in terms of sales and development in Bangalore. A lot of new things have happened in Bangalore. Good infrastructure roads have opened. New corridor of metro will be opened. So good action this year. A lot of stability. There is a good amount of traction happening in associate sectors like IT, technology. Of course, there are some red flags in terms of some startup companies not doing well, and you must have heard about these things. But overall, if you look at tech sector in Bangalore followed by real estate sector, probably is doing much better this year. That's good. The reason I am doing this today's podcast is suddenly something has happened 2 days back in the budget proposed by the government. There's a very very major thing which has happened, which is probably will have a huge impact on the real estate market, especially the resale market as well as the new acquisition also. You must have heard about this indexation benefit, which has been removed from the real estate sales and purchase transactions. So just to give you the background, and just to maybe start from scratch in terms of what is this. Maybe a lot of people know about it, but then at the same time, assuming probably many of you may not be aware of this in detail. They must have heard about what came in news, right? So there's a lot of confusion, but probably I'll try and decode it in a very very simple way for a layman person who's looking to do any business in real estate or transaction in real estate. So it's a very simple thing. Let's say someone has purchased a property, let's say 10 years back in 2014 or 15 or something, let's say at 100 rupees. Okay. And then today he's selling that property, and let's say the property price, sale price is around 250 rupees, right? So in a wholesome value, you can say the upside is around 150 rupees. So he has made a profit of 150 rupees. So there is a capital gain tax which is 20%, which was 20%, but then you don't pay 20% tax on the full profit. Like cost price was 100, selling price was 250. So the benefit is 150. But then what in the earlier plan was, your purchase price of 100 rupees in 2014 is indexed. So there is an index published by Income Tax Department which tells about how a notional value will be attached to every purchase. So property purchase in 2014 or 15 at 100 rupees will be valued at, let's say, I'm just taking a raw number, let's say 170 rupees. So your profit is actually not 250 minus 100, which is 150 rupees. The profit is actually 250 minus 170, which is 80 rupees. So you were getting taxed at 80 rupees at 20%. So you were paying, let's say, 16 rupees as your tax. But in the reverse scenario, the things have changed. Now the indexation benefit is gone. So there is no factor of getting inflation attached to your cost of acquisition. So whatever cost of acquisition was there in 2014 remains same. And then you take the gross profit 250 minus 100 and then multiplied by 12.5%. The tax rate is reduced, but then it is without indexation. So of course they will be having some impact, right? So in some cases it may be more, in some cases it will be less. Of course government is saying as per the calculation, majority of the buyers will not be affected, but of course people will be affected. It purely depends upon two things: at what price you purchased and when you purchased. Actual year is, let's say, 2024. So the older the property acquisition and the lower is the price, it will have an impact on the capital gain calculation. So I'll just show simple illustration how a calculation is done. Let's say someone has purchased a property in 2007 for 40 lakhs and he's selling this property today at, let's say, 1.5 crore. Right now, if you look at the index published by the government of Income Tax Department, the index value was 117, 122 in 2007, and it was 348 till last year. So the multiple benefit will be 348 by 122, which comes to around 2.85. So your property purchase at 40 lakhs will be valued at 40 lakhs into 2.85, which is 1.14 CR. Now, if you look at the calculation, you have made a profit of around 36 lakh rupees, okay, with the indexation benefit, on which you will pay 20% tax. So it will be around 7.2 lakhs. Now, if you remove the indexation benefit and you simply take the profit, which is 1.5 CR minus 40 lakhs, so which is 1.1 CR, if you multiply that with the current rate, 12.5%, so approximately 13 lakhs. So your tax liability has increased. It is purely a function of the purchase price, which is 40 lakhs, as well as the purchase year, which is 2007. So what we thought, let's do something to simplify it for people who don't want to do this calculation. Ultimately, it's a factor of only the purchase price and the time or the year of the purchase. How the capital gain used to be calculated, and if you want to create an equation in terms of see how it was calculated earlier and now how it is calculated, the capital gain calculation as per the previous system was selling price minus cost price into index into 20%, which is the capital gain tax rate. That was the older one. The new one is selling price minus cost price into 12.5%. Areas or for the options where the benefit out of the new regime is better, the capital gain value should be higher for the previous regime. So if we put in an equation, what we are trying to say, selling price minus cost price into I into 20% should be greater than equal to selling price minus cost price whole multiplied by 12.5%. Simplify this equation, you will be able to arrive at a factor, what we call growth factor is. Growth factor is how your property price is appreciated. So no matter which year they have purchased. Now, if you purchase the property in a particular year at a particular price, your selling price today divided by cost price historically should be a multiple of 8 into the index value minus 5 by 3. This is a simple factor where you can just put I. Now I is the index. Now it purely depends upon at which year you purchase. So if you look at, I'll show you a table. If you look at the year from 2001 till 2024, the index value for first year 2001 to 2002 was 100, and for the year ending 2024 was 342. So the index multiple for any property which was purchased in 2001 to will be 348 divided by 100, which is 3.48. Similarly, any property which was purchased in 2002 and sold now or later, the index multiple will be 348 divided by 1.05, which is 3.31. So if you look at the table, it shows the index value or index multiple based on the year of purchase for each year. For 2001 3.48, let's say 2010 it is 2.08, 2017 it is 1.24, and 2024 it is 1, because same year. What we did is we put this value of I in the equation to arrive at the growth factor, which is the minimum factor at which your property should have increased or appreciated, so that the new regime will be better for you. So the growth factor for the property which is purchased in 2001 will be 7.61. What it means is, if someone has purchased a property in 2001, 2002, in that financial year, his property price should have increased by at least 7.61 times, then the capital gain will be better in the new regime. Otherwise, capital gain will be more in the new regime. Similarly, if you look at the growth factors, I'll just take some random number. Let's say the property purchased in 2007, the growth factor is 5.53. So what you have to do is you take this growth factor and multiply by your cost of acquisition. What price you will get is the minimum price you have to sell to make a better capital gain tax or the lower capital gain tax liability in new regime versus the old regime. It looks interesting. It's a simple way to put it how you have to arrive at your sale price. Of course, it depends upon the market price and how the market is going on. You can't just demand multiply the price by, let's say, whatever the growth factor and ask the buyers to pay that price. But it gives you some idea in terms of is it the right time to sell the property or not. If you look at the pattern, probably it's very obvious, the properties which were acquired before 2000, let's say 10 or 12, like maybe the first 12 years, if you divide from 2001 to 24, the first 12 years of the indexation year, whatever properties were purchased, they have to achieve a higher value today to be able to get that benefit versus the properties which were sold in last 12 years, because then probably it will be much easier for those property to achieve a growth factor. So if I just take an inflection point, which is 2012, the growth factor has to be from 7.61 to 3 till 2012. So the growth factor reduces from 7.61 to 3 uh, to be able to get the benefit of the new regime. But then from last 2013 till today, it is 3 to 1. So definitely the fall in the growth factor is much lower. What it means is, if anyone who has purchased property in the last 12 years are going to get the benefit of the new regime, and anyone who has not bought the property or has bought the property in the first 12 years, like from 2001 to 2013, 12 13, they probably will be, either they have to sell the property at a much higher value based on the growth factor of the particular year of purchase, then only the new regime will be better. We have taken a scenario where, let's say, someone is selling a property at 3 crores today. Uh, the property was purchased in 2002-3. Now we have kept the sale price constant, but we have done the variable cost price, assuming at what price he purchased. We have tried to create a scenario with the variable cost price. So starting with the first option, where let's say he's purchased the property at 35 lakhs and he's selling at 3 crores. So the index cost for the property as on date is 1 crore 16 lakhs. So by that, if you look at the growth multiple or growth factor is 8.57. The minimum growth factor required for this scenario, where the property is purchased in 2002-3 and selling now, is 7.17. So the actual factor realized by the client is 8.57, which is greater than the growth factor. So in this case, the new regime will be better. You can see the old regime calculation, tax calculation liability is 36 lakh 80,000 and the new regime 33 lakh 12,500. So you can see the new is better. Similarly, we have increased this cost price by 50,000 onwards, and we have created multiple scenarios to see how it is affecting the decision or the scenario where the new regime is better. The other thing is, of course, if you reinvest the capital gain, then there is no tax liability. You can avoid that. So earlier, that because the capital gain price was less, the capital gain calculation or valuation was less, people used to invest only the upside capital gain only in the new property and will take back the principal and the notional appreciation. To simplify, I go back to my first example. Let's say you purchase the property for 100 rupees. The indexed value or indexed cost of that property is 170 today, and you're selling it 250. So in earlier scenario, you have to reinvest only 80 rupees, which is 250 minus 170, to get the tax advantage. But now you have to reinvest the full capital gain. Like you can only take away the principal amount at which you purchase the property. The benefit of that property purchase over 10 years indexation is no more there. You have to reinvest that amount also. So instead of investing only 80 rupees, you have to reinvest full 150 rupees. So from that perspective, people who are looking to invest back in purchasing a new property, it may not have much impact. In fact, it probably works better for real estate, because now there will be more amount or quantum of money which will be available for reinvestment. So it's not only the notional benefit of selling price minus cost price into index, it will be selling price minus cost price, the full upside which a property is seen or the growth which is seen will be reinvested. One has to reinvest the full amount. So I think it may work either ways. If you are actually looking to sell a property and buy back and reinvest the whole amount, it will not make any difference for you probably, because anyway you're not paying any capital gain tax. But if your property is older than 12 years, 12 year plus, then you have to rethink whether you want to get that selling price, which may be difficult in some cases, it may be possible in some cases, or you may have to reinvest the full capital gain. So that's the question which probably you may have to think and you have to decide before actually deciding on selling any property. This is very critical and it's very important, because it will have huge impact. If I ask me, people who are actually moving cities, like someone who's actually was living in Delhi or Bombay and moving to Bangalore, or someone who's living in Bangalore and moving to Hyderabad, or people who are living in multiple cities and have multiple properties, if they are doing this just to buy another property in the new year, new city they are shifting, it may not have that impact. Probably anyway they have to invest the full amount, full money or full capital gain to buy the new property. The property flippers, maybe they may be a challenge because they may not be able to withdraw the full benefit of indexation. Like they were taking away full money, they will be able to take away only the principal amount, which probably may have some impact on their plan of doing this flipping of property or investing and reinvesting properties and making growth out of it. But for regular end users who are actually buying house, or who are actually looking at upgrading, like someone has bought a 2 bedroom and now is selling and buying a 3 bedroom, or someone has bought a 3 bedroom and buying 4 bedroom by selling 3 bedroom, probably for them it may not have much impact, unless there is some scenario where they have to actually sell and take, they need that money or the capital. So in those cases, it depends upon how much appreciation they've seen, purely based on the growth factor. Hope this video gives a clarity on how the calculation is done and how you can assess whether the new regime will be better or not for you. We'll also share the calculation and the research material in the description. Still, if you have any doubt, any clarification, please feel free to put a comment in our section and approach us. We will definitely come back with you and we'll do the sharing with you. If you have any specific scenario also, please share your details. We'll do the calculation and share with you whether what factors are working for you. Hope it was useful. Nice day. Thank you.